behavioural finance from biases to bubbles. Take it away, Paul.
Good morning, ladies and gentlemen. My subject today is behavioural finance. How do we apply these behavioural economic ideas in the world of investment? And my particular interest, as someone that studied history many years ago, is stock market bubbles, when markets go crazy, when markets go mad. And I think everyone here is very familiar with the way that we think or the way we don't think. I just want to give you some ideas about how it affects us in terms of the marketplace. And I thought I'd start off with one of my favorite illusions. It's called the Jastrow illusion, to show you how the mind sometimes works and sometimes doesn't work very well. I think to everybody in the room, it's clear that the yellow shape looks considerably smaller than the green shape. And yet, I suspect you know what's going to happen next. I'll turn them around, and now it's the other way around. The green shape looks smaller. And just to show you on the screen, now even though I've seen this 1,000 times, because of course they are the same size, my mind is still fooled. And I think if there's a theme for the next 20 minutes or so, it's going to be how our minds do get fooled sometimes by our own biases, by randomness, by things that can affect us in terms of the marketplace. So let me start off with another, if you like, one of my favorite subjects about people liking patterns. And if behavioral finance teaches us one thing, it's that we like to find patterns, but we don't always go from A to D via B and C. So what do? Well, we have this fast and slow thinking, system 1, system 2. And interestingly, take something like the desire to find the patterns of human faces, a concept called pareidolia. It's evolutionarily important that we can recognize human faces very quickly. Think of a newborn baby recognizing its mother. Think of, in the ancestral environment, trying to watch out for friends and foes. But the human mind is so good at spotting faces, it sees faces where they don't often exist. And I just want to give you 2 or 3 examples of that as an illustration to how the mind doesn't always work as rationally as we think. That is a thing called the Mappakansack pebble. It's 2.5 million years old. That face was not caused by somebody chiseling it out. It was caused by a stream, rolling around in the stream in Africa. Now, why do I think this is important? Because somebody, one of our ancestors, it certainly wasn't Homo sapiens, picked this thing out of a stream 2.5 million years ago and carried it from miles away and left it in a cave. So even then, the human mind was hardwired to recognize faces. And of course, there are some funny examples as well. 2 of my favorites. People seeing religious iconography in pieces of toast on the left. The headline, by the way, was Father, Son, and Holy Toast for that one on the left. On the right, in 2004, a lady in America was eating a piece of grilled cheese. She took a bite out of it, as you can see. She then saw what she thought was a religious icon, a face in that grilled cheese. She sold it on eBay. Does anybody know how much a piece of grilled cheese went for in 2004 on eBay? Anyone want to call out? You can win the Jastrow illusion, with which you win a lot of beer in the pub later as well. I haven't heard it yet. $28,000 is the answer on eBay for a piece of grilled cheese. My favorite piece of pareidolia of all time is the next slide, and I call it the confused washing machine. Behavioural finance. I think we've had some good allusions this morning to the history of it. I do agree with Rory. I think Adam Smith was the first person to talk about empathy, which is a very important part of behavioural finance. But in terms of how we study it today, you've got to go back really to the 70s, and Danny Kahneman and Amos Tversky were really 2 of the major pioneers in this. And it's been taken up by others, by economists, by non-psychologists, and now the whole thing is fusing together nicely, economics and psychology. So what are the key ideas in behavioural finance? Well, firstly, that investors are not so much rational as normal. They can be rational, they can go from A to D via B and C, but often they have these biases, these heuristics that make them less than rational. Markets are certainly not always efficient, they can be again, and risk and return are not always as closely correlated as you'd like them to be, according to the traditional economic textbooks. And if in doubt, quote Warren Buffett, I would be a bum on the street with a tin cup if the markets were always efficient. So they can be, stocks can be fairly priced, bonds can be fairly priced, but sometimes they're not. And as I say, I'm interested in stock market bubbles when the markets go mad. I hope everyone in this room has read this book. If you haven't, you're in for a treat. It is a brilliant, brilliant piece on behavioral economics generally. And of course, we've already discussed this morning the idea of thinking fast and slow. We like to think fast. We actually naturally are hardwired to think about system one, to do things the system one way. So let's just talk about one bias in particular that I find very important, particularly when thinking about stock markets, the herd instinct. Information cascades. You choose to do what someone else is doing. You think they know something you don't. You follow them. And it's a very, very common bias in the marketplace. And again, nothing wrong with that if you know what you're doing. But I think my conclusion to the whole of this is about avoiding mistakes. If you know you're doing it, fine. It's people who aren't aware they have this bias that are the ones that are creating potential dangerous investments themselves. And of course, this does lead to bubbles. Now, I just want to we have a smart crowd in front of us today. May I just try and test the herd instinct among you? Would everybody please pick a card and remember its suit, its color, its denomination? Everyone got one? Let's mix them up. Let's get rid of one card. Please put your hands up if your card has gone. The herd instinct in action. And of course, in markets, the herd instinct can lead to a great emotional roller coaster of a ride. And just a schematic there, which I like very much. If you're buying something and it's going up, you feel good and you start to get excited, optimistic. And of course, with hindsight, it's pretty clear that you feel very, very good at what later proves to be the top of the market. But interesting, when people feel the most good about their investments or the marketplace, with hindsight, it often proves to be the most dangerous point to invest anything. And conversely, when the markets have been going down a long way or crashed, and everyone feels really gloomy about everything, that is a great time normally to buy, of course, and yet everyone feels so miserable and bad about it. And one of the great first bubbles ever documented by a guy called Charles Mackay in his 19th century book was about the tulip mania in the previous century, where people got excited and euphoric about buying tulips in Holland. And to us it seems crazy. Why would you want to buy a tulip? Well, they had wonderful colors, wonderful shapes, and they became a sort of symbol of upper-class society in Holland at the time. And there were stories abounding that some tulips changed hands at the top of the bubble for 10 times the average annual skilled worker's wage, which seems phenomenal to us. And yes, there was this bubble in tulip prices. And that may seem pretty crazy to you, and yet I put to you that bubbles are just as we've seen craziness in very recent years. The internet boom, we saw much more crazy things than that. This, of course, was the time in the 90s where the internet opened up so many companies to try and make money. The world was going to change, a new paradigm, and yet very few companies made money. We sure know the ones that succeeded, the Amazons of this world, etc. But there were lots of ones that fell by the wayside during this amazing boom. And there were some extraordinary stories about stocks that just rose because they were tech stocks, and yet they had no money, no earnings, no revenue, no future. My favorite story about the tech boom, one of my favorite stories, of which there are many, is a company called Norris Communications. Norris Communications used to do voice data stuff and sort of tape recording type stuff. And interestingly, they thought that they should participate in the tech boom, and yet their share price was stuck at 6 cents in the US, 6 cents, 6 cents, 6 cents every day. And yet all the tech stocks were roaring up, absolutely going mad. Norris Communications had an idea. Would they change their product? No. Would they change their distribution? No. Would they change their management? No. They would change their name. They changed their name to eDigital. eDigital. That E was, of course, what I is today. eDigital. The stock went from 6 cents to 16 cents to $6 to $16 and peaked at $24.50, largely on the basis of a name change during the tech boom. So when I look back to that tulip bubble, I think maybe they weren't so stupid in those days, because at least they had a tulip out of it. And of course, You won't be surprised to know that the aforementioned stock I mentioned is no longer trading at $24.50. It's back to a few cents. Bubbles are crazy. And so Isaac Newton, who was a smart guy, he got involved with a bubble called the South Sea bubble. And interesting, he invested a lot of money in it. He did very well. He doubled his money. He thought, I'm a smart guy. I'm going to sell now. But if there's one thing to really annoy people, it's watching your friends get rich. And he saw his friends get rich, and he re-entered the market again. He bought loads more. He bought a much, much bigger investment, and he got it wrong. And this wonderful quote from him, which I think is magnificent, he said, I can calculate the motion of heavenly bodies, but not the madness of people. One of the smartest men at the time fell for the bubble. Now, don't think they're historical. As I said, I mentioned the tech boom earlier. This is a chart going back to 1998, all on the same scale, the same time scale, and the same y-axis. And you can see the tech bubble there, the first one, how quickly stocks rose. A few years later, the US housing market, and then a few years later, the commodity bubble. So bubbles do happen quite a lot. And I'm reminded of Mark Twain's comment that history does not repeat itself, but it does rhyme. And you can see the rhythms there. Now, one of the things that people say to me is, well, surely if you're an investor, you can get out of bubbles fairly easy. You can ride them up and then sell before everyone else does and before they crash. Yes, in theory you can, and many people can do that successfully. And the problem with that, of course, it feels a bit like speculation. And for someone who's in the business of long-term investment for pension funds in particular, it's not a game that I would certainly try and play. But there are momentum traders in the marketplace that do try and play the bubble. So let's just try and experiment with, can you get out of a bubble at the top? And let's just think about, we're investing in a tech stock. We'll try and experiment if we may. Could everyone just put their arms out like this? We're going to buy in a tech stock now. Could you just cross your arms over? Turn your hands down and clasp your hands together, right? We're all now locked into these tech stocks. It's easier if you have your elbows straight. So we're all now locked into tech stocks, okay? And the market starts to go up and up and up and up and up. And it's fantastic. We feel good. We feel euphoric. It's time to get out. How easy is it to get out? Well, let me be the first investor to get out. I will sell. To symbolize selling, I'm going to simply turn my thumbs over from the floor to the ceiling. Just let me do it first and then follow. Here we go. So Paul now sells, and he's out. You do it. And the market's now crashing 10%, 20%, and you're locked in, and you can't get out. Bubbles are very awkward, because once they crash, they affect the real economy. And of course, it was the US housing market bubble that really had the ramifications for the whole credit problems that we've had in recent years. If you're interested in bubbles, there's a wonderful book by a guy called Charles Kindleberger called Manias, Panics, and Crashes, who studies the different phases of the bubbles. He goes back and studies all the bubbles you can find in history and finds this idea there are patterns. Similar sorts of things happen at different phases of the bubble. And for example, one thing, they're always associated with low interest rates, people borrowing money to invest in stocks and sometimes in derivatives. When they crash, there's always a backlash, because clearly it affects the broader economy in many, many cases. And as I say, the US housing market bubble a few years ago is causing ramifications even today. What happens at the top of markets? Well, people feel incredibly bullish, as I say. And I look back to 1999 when this bubble was really going mad. And 3 books came out that I remember. The Dow Jones at the time, the Dow Jones index of stocks was at 11,750. And a book came out saying, no, the Dow's going to 36,000. And not to be outdone, someone said, no, it's going to 40,000. And ladies and gentlemen, for me, one of the most dangerous phrases in investments in my 25 years, if you hear someone say, it's different this time, run for the hills. New paradigm, run for the hills if you hear that phrase as well. It can be, things change, of course they do. But in terms of the rhythms of the stock market, often things that just look like previous cycles. Interesting, at the bottom of the markets, people are too gloomy. 1979, Business Week, the big US financial magazine, declared ahead of the biggest ever bull run, where stocks were rising for 20 years, as it followed, that actually it was the, quote, death of equities. So again, this emotional response, this system one type thinking, too bearish at the bottom, too bullish at the top. I want to just try another experiment with you, if I may. I won't tell you the scale of this or the price. I want you to try and predict where this price goes, this chart goes. So it starts off, and it does rather well. The stock tends to go up. And now, what happens now? It's had a good rise. Just by a show of hands, hands up those who think it's going to go up further or it's going to correct. Those who think it's going to go up further, arms up. Okay, and I think that's more people think it's going to correct. Smart crowd, it does indeed come down. You get the idea. Quick show of hands. What happens next? If it's going to go up, hands up, please. Much more than some. We have a very smart crowd, it does indeed go up. What happens next, please? Does it go down? Hands up. If it goes down, hands up. Okay. Now, those who follow charts think this is an important level. It's back to sort of what's called a support level. Is it going to crash down through it and plummet to the bottom? Or is it going to keep up and return back to its old highs? Hands up those things that go back to the old highs. A minority. Interesting. That's what it does. And finally, the last move. Do we buy this stuff or do we sell it? Hands up those who want to buy it. Hands up those who want to sell it. Very, very good indeed. Down it goes. Now, does anybody have an idea? I mean, some of you may be thinking, what is this? Anybody know what happens next? What happens next? Shall I show you? Ladies and gentlemen, what happens next is Brisbane. This is a map of Australia. I want to thank my friend Gerald Ashley, who came up with this idea a few years ago. And also, my brother, I think, is watching this in Australia, so good on you, Neil. That's for you. So let me just go back to a point that Rory made. Rory said a lot of this is about not making mistakes. And for me, one of the wisest things I read in 25 years is a short paper by a guy called Charles Ellis, written in 1975, called The Loser's Game. And Ellis wanted to look at investment and wanted to see what made a good investor. Because despite what you think, I do think there are plenty of good investors out there, and they really are. And Ellis came up with something that was so profoundly simple, but I've never forgotten it. He said, he likened it to a game of tennis, amateur tennis. And he said, if you actually watch amateur tennis players playing, very few players actually win points. The other player loses. He hits it into the net, or she hits over the end of the line. And Ellis said, you just need to keep in the game. Hit the ball back. And interestingly, in investment terms, it is true. People do try and take on too much. They take on more than they can chew. They grow too big too fast. They change their style. And Ellis's basic rule is, avoid the losers. Get the ball back. Little and often is the way forward. Don't try and knock the lights out. And I think that behavioral economics tells us that we make mistakes and helps us identify them so we avoid doing them. That's why I think it's a real thing. So I don't think it's going to make you the best investor in the world, but if it stops you making the bad, silly mistakes, then it's incredibly useful. And if you haven't read Charles Ellis's paper, do it. It's on the internet. It's about 5 pages long. He then wrote a book about, in 1999, fleshing it out, but the original paper is so wise in its simple profundity. Finally, nudge. How do we use this stuff for the benefit of society? And here's an example of a sign that I think is a nudge, but actually I don't think it's a very good one. Pickpockets operate in this area. Now, why is that not very useful? Because what happens when people see that sign, and this particularly is true of men, they tap their pockets. So where would you sit or stand if you were a pickpocket? Trying to find the easy pockets to pick, but which, by the way, are these ones here, I'm told. If you take those signs down, there's evidence to show that pickpocketing incidents fall, because it's much harder to pick pockets. Let me show you a good nudge. I think this is a brilliant nudge, and I love it because I think it does help. It does show you in a simple way how you can make society better. I want you to imagine that you're in Paris. You've had a bad day. Maybe you're a taxi driver or something, and you need a cup of coffee. And you walk into your favorite cafe, and you see this sign. Un café, €2. Un café, s'il vous plaît. If you say please, it's only €1.80. How would you order your coffee? So let me sum up now. For me, behavioral finance is fantastic because it tears up the traditional model. Or it maybe doesn't tear it up, it just adds to it. It adds to the traditional model. It says that people aren't always rational. They can be, but sometimes they go crazy, and we talked a little bit about bubbles today. Markets certainly aren't always efficient. They can be fairly priced, but sometimes they get to extremes in sentiment, too bullish or too bearish. And just being aware of some of our biases, and we try to show you some today, I think reduces some of the dangers, the mistakes, the downside consequences of them, and offers opportunities for upside in all areas of our life, not just in investment terms. Another optical illusion, it's called shades of grey. Only 2, I'm afraid, not 50. Shade A and shade B are the same shade, and if you want to prove it to yourself, just shut one eye, put a finger out, and cover up the white stream of light in the middle. And I've seen that, again, many times, and it doesn't actually, it still fools me. And just to prove it on the screen, and I'll cover it a little bit. So what's the point of my talk? We are hardwired to have biases in investment like everywhere else. But as long as we're aware of them, you've taken the sting out of them, the danger out of them. You can avoid the losers. So with that, continue to challenge your beliefs. Thank you very much indeed.
Wow, what a morning. Could I please ask